The Indian stock market is a platform where individuals, institutions, and corporations can buy and sell shares of publicly traded companies. It is one of the largest stock markets in the world and plays a crucial role in the Indian economy. The Indian stock market is comprised of two major stock exchanges, the Bombay Stock Exchange (BSE) and the National Stock Exchange (NSE). These exchanges provide a platform for buyers and sellers to trade stocks and determine the prices of these stocks based on supply and demand. When more people want to buy a stock than sell it, the price goes up. When more people want to sell a stock than buy it, the price goes down. To participate in the stock market, an individual must open a brokerage account with a registered broker. The broker acts as an intermediary between the buyer and seller, facilitating the transaction and executing the trades on behalf of the individual. There are several types of brokers, including full-service brokers, discount brokers, and online brokers. An individual can choose the type of broker that best suits their needs and budget. Once an individual has opened a brokerage account, they can start buying and selling stocks. They can buy stocks by placing a market order, which is an order to buy a stock at the current market price, or by placing a limit order, which is an order to buy a stock at a specific price or better. Similarly, individuals can sell stocks by placing a market order or a limit order. The Indian stock market is regulated by the Securities and Exchange Board of India, SEBI, which was established in 1992. SEBI's role is to protect the interests of investors and maintain the integrity of the market. It does this by enforcing rules and regulations that govern the functioning of the stock market and by ensuring that all participants, including brokers, comply with these rules. Another important aspect of the Indian stock market is the use of derivatives. Derivatives are financial instruments that derive their value from an underlying asset, such as a stock, commodity, or currency. The most common type of derivative in the Indian stock market is the futures contract, which is a contract between two parties to buy or sell an underlying asset at a specific price and date in the future. Derivatives allow individuals and institutions to hedge their risk, speculate on future market trends, and make more informed investment decisions. However, derivatives can also be complex and risky, so it is important for individuals to understand how they work before investing in them. The Indian stock market also includes mutual funds, which are investment vehicles that pool money from multiple investors to buy a diversified portfolio of stocks, bonds, and other securities. Mutual funds are managed by professional fund managers, who use the pool of money to make investment decisions. Individuals can invest in mutual funds by purchasing units in the fund. The price of a mutual fund unit is determined by the net asset value (NAV) of the fund, which is calculated by dividing the total value of the fund's assets by the number of units outstanding. In conclusion, the Indian stock market is a platform where individuals, institutions, and corporations can buy and sell shares of publicly traded companies. It operates on the principles of supply and demand and is regulated by the government through SEBI to protect the interests of investors. For more videos, subscribe to this channel and click the bell icon for instant notifications.